We've got Vivek Rajpal, who's a rate strategist at Nomura India. He joins us live on the show from Mumbai. Vivek, to begin with, next week's credit policy, what are you all expecting?
We are expecting 25 basis point of repo rate cut and probably a cautious language from Reserve Bank of India.
On the CRR?
No, we are not expecting a CRR cut because according to our calculations, liquidity is comfortable, and as we go ahead, we think liquidity will be comfortable for the next quarter or so. However, the only risk to the liquidity scenario is any RBI FX intervention. Otherwise, we think liquidity is comfortable, and given CRR is already at 4.75%, we think from here on RBI needs to cut repo rate rather than CRR.
Vivek, last week you saw the bond yields spike to a 4-month high of 8.78%. They have seemed to ease off considerably. Do you think that the bond markets have factored in a rate cut? Yes. There are certain aspects as far as the back end of the curve is concerned. So there is, of course, the monetary policy expectation. Going into the credit policy on 17 April, bond yields have rallied. So yes, one can say a rate cut, a 25 basis points of rate cut is priced in. However, the overall macroeconomic situation will also be important for the bond yields, and probably bond markets will be very carefully watching the language that RBI use in terms of forward guidance. So if we get a dovish language, bond yields can rally, but looks like the first 25 basis point of rate cut is already in the price.
All right, now, you know, Vivek, you did speak about the liquidity situation likely improving, and you're not expecting a cut on the CRR simply because you expect, whatever government spending and all of those issues to take care of the liquidity picture. You did, however, mention that this is barring the rupee weakening and the RBI being forced to intervene. Now, pretty much everyone we speak to in the market believes that the rupee will, most likely visit levels that we saw in November and that the RBI will intervene, which in turn is going to worsen the liquidity situation. Why do you believe it's not going to happen?
We have a fairly constructive view on INR. We think the move has already played out, and from here on we'll see a range-bound INR markets. Probably we'll see a gradual appreciation. As far as now, if I take this, if I connect this logic with the liquidity infusion, we think the preferred tool of liquidity infusion would be rather open market operations than CRR, because CRR is already at 4.75%, which is really low if one looks at in the historical context. So, as far as liquidity angle is concerned, we think if the need arises, which we think if it arises, it will be a very minimal rather than what we saw in November, December when we had a systemic risk off, to say so. The liquidity infusion will be rather through open market operations, because there will be a small liquidity infusion requirement rather than a big bang. Also, given the CRR levels are very low, probably that will not be the preferred tool.
Vivek, you do have volatility, which is a dominant factor in the currency market. So in the long term, what's the range that you're looking at for the Indian rupee, given that we're already at a 3-month low?
Yes, so we think the current levels should be held. We think a gradual appreciation rather than I would say a range-bound market. We think 52 on the upside and 50 on the downside for next couple of months is very likely, or rather, if anything, it would rather breach the 50 rather than 52. That's what our view is.